All right, Hunter, it's good to get back for another podcast. I think today's topic is certainly on the mind of a lot of investors more so than it has historically. And we're talking about the federal deficit, federal spending, federal budget. And now that's kind of finding its way into markets as part of the conversation around, hey, is this debt sustainable? What are the market implications going to be on a go-forward basis? And how is this the dynamic where the US government is spending so much money? How is that going to impact both the United States in general and then the markets as a whole?
Yeah, it's this really interesting thing where people haven't really cared about this for a long time. And we'll get into reasons why, now it's such a big deal and it really hasn't been in the past. There have always been people calling it out, and we're kind of reaching that point where it needs to be addressed. We're on an unsustainable path where currently just our interest payments take up as much of the budget as our non-discretionary, non-defense spending. So that's all the little things the government wants to go do. Interest burden is the same size as that. So it's really creating pressure on our budget and preventing the government from doing the things that borrowing in the first place was meant to allow for.
And just a quick reminder, if you're enjoying this podcast, please like and subscribe to our channel. Follow us on Facebook, Instagram, YouTube, and everywhere you can get your podcasts. Yeah, and I think a huge part of that is now you're getting to these really astronomical debt levels. We're seeing projections and almost a certainty at this point that the US debt is going to surpass 100% of GDP in 2025. And that's and so you're talking about budget deficits that are over $2 trillion. So that's not just government spending, that's the deficit on a yearly basis. And that's something that's very, very concerning as an investor. It's concerning as a citizen of the country, frankly. But as we're going to kind of talk about, there's going to have to be some moment when the US is going to have to reckon with this. For so long, we've been kicking the can down the road and looking at this as if it's not something that we have to deal with right here and right now. But I think the more that the public hears about it, pays attention to it, and especially now that financial markets are getting concerned about it, I think is really going to be impactful as far as furthering the conversation to some kind of fiscal austerity.
Yeah. And so part of the reason why, getting to that point of why it's such a big deal right now, because like you mentioned, it's been going on for a while. But it's reached all-time highs. It's huge proportion of our total GDP. It's going to surpass 100% of our GDP, like you mentioned. But now that we're at higher interest rates due to the Fed tightening policies, it costs more than ever too. So all of that new spending, all of that new borrowing is financed at these higher rates. Whereas in previous years, we could borrow all we wanted because the 30-year was down in the 3%, sub 3% range for the past decade before all this happened. We're at a point that fiscal discipline is so much more important because of the increased costs of new issuance borrowing as well as servicing that cost. We're currently borrowing to supplement more than a quarter of our total budget. So that really shows you the disconnect between our tax receipts and our spending. And we're just having to find a way to reckon those two.
Yeah. And I think what's really a critical piece of this is it's not that we're running these huge deficits under a recessionary period or some kind of depression in the economy. We're talking about running these huge deficits when unemployment's at close to an all-time low, when the market is performing extremely well, when wages are increasing, the labor market is really tight, and economic growth is, relatively stable, and the consumer is doing well. So it's concerning that you are running such a big deficit when tax receipts are also, through that economic growth, should be higher. I mean, this isn't like in 2008 or during a COVID period when you have a recession that you're dealing with. A slowdown in the economy, of course, is going to create lower tax receipts and increase government spending. But we're talking about a pretty good economic environment, and we're still running deficits like this. it's really just not sustainable, and it really doesn't prepare us well for if we do encounter some kind of recession and spending either has to tick up or tax receipts all of a sudden take a cut. So that's something that we really have to pay attention to.
Yeah, and to that point, we're currently in a situation where monetary policy is very tight. Fiscal policy that the government is instituting is very loose. It's very stimulative. Spending all of this money puts dollars into the economy. That's inflationary on its own. And, it's, as you mentioned, it's usually done during bad times to promote and stimulate the economy. But the Fed's trying to reduce all of that activity through its actions. So they're really at odds right now. And so we have the government fighting the government basically right now.
Yeah, I remember when we were talking about this exact problem when it was 2022, the Fed was embarking on its rate hike campaign. Inflation was going through the roof, hitting those 9% levels. And we were looking at, hey, the government is spending all this money while the Federal Reserve is trying to cut back the amount of money flowing throughout the economy. They're really not in parallel with each other. Those are really conflicting. And so it's been interesting to see how the Fed has, luckily to their objective, prevailed to some extent and to a greater extent, which is something that we'll get into, in further podcasts as we continue to talk about the Fed and rate cuts and interest rates. But that being at odds with fiscal policy has really made it harder to fight this inflation battle that we've been dealing with over the last, 2-3 years.
Yeah. So moving off of this onto, so we have the problem, we have what's currently going on. What have the ramifications been? So we were downgraded, the US government was downgraded credit rating in 2011, coming out of 2008 and the great financial crisis, and all of the issues that we had back then, by Standard & Poor's to AA+. And recently, in the end of 2023, Fitch followed suit and downgraded us as well. So you want to walk us through kind of what that means for the US economy and what it means for future borrowing?
Yeah, so I think that's the big concern. You've got major credit rating agencies who have always declared US debt as the safest possible thing. I mean, they called it essentially risk-free. Whenever we as financial professionals refer to a risk-free rate, we're talking about government treasuries essentially. So the fact that you have to start considering a world in which the government may not be able to pay off that debt at some point in the future, I don't think that's the concern right now. But it's something that market participants are certainly thinking about. These credit agencies are paying attention to. And they're saying, hey, if you're incurring debt on an unsustainable basis, how do you expect to pay all of it off sometime in the future? And so we've been issuing, the government issues treasuries all the way from very short dated treasuries through 30-year maturities. And recently, kind of to your point of interest rates being higher, have been issuing more debt at those low interest rates in order to have this kind of sustainable rollover in that debt so that they can refinance at lower rates. I think it's really interesting hearing from some, market minds about how the government really should have just extended all of its debt back during COVID when interest rates were near zero. You could have financed everything for 10 to 30 years at, call it, under 2% conservatively. But the U.S. government didn't do that. I mean, of course, they're not supposed to operate necessarily like a hedge fund or investment shop, but could have been something smart for the government to do during that period. But getting back to the whole point of why is this impactful is that the U.S. currently is the global reserve currency, the U.S. dollar. And if you start to undermine the idea that the government may not be able to pay back its debts at some point in time, it really undermines that fact. And we've always really benefited from the fact that the US dollar is the global reserve currency. Everyone knows they're going to get paid back by the US government. The vast majority of global trade is transacted in US dollars. And so maintaining that is a huge benefit to our economy. And that's something that we really don't want to lose, both from an economic and a financial perspective.
Yeah, when you have foreign countries like interacting with each other in US dollars, it's really kind of goes to show the impact that the US dollar has as a reserve currency, because for the longest time, and you've seen some changes in this recently, but primarily still you have oil transacted, from the Middle East into Asian markets, or, out of Russia and stuff, transacted in US dollars. Oil markets are denominated in US dollars, outside of a few transactions we've seen recently with people trying to move away from that, but that's not really a concern that they will. But we've had that ability for the longest time to be a global reserve currency in that way, that, if, to your point, if we continue on this course, may not persist. So that has all sorts of implications for the US, both domestically and globally. Obviously, the global influence that the US, enjoys as our, world power gets undermined a little bit there. But also domestic companies, when you have imports and exports, dollar weakness driven by this spending and potential, government issues is really, really affected, and it can hurt us domestically and globally.
Right. If you're talking about buying international goods from other countries denominated in US dollars, you want dollar strength to stay relatively high. We currently have, a surplus, or a deficit as far as our international trade goes. So we're spending more US dollars than we're bringing in by conducting trade. And so when your dollar's strong, you're able to buy those international goods at a cheaper relative price. And so it's really beneficial to maintain some form of dollar strength for a lot of reasons that I won't get into. You don't want the dollar to get too strong, because then you're talking about hurting your exports, but maintaining a relative dollar strength is very valuable. And then I think the other piece of this is that interest rates are more than likely going to increase if people get more and more concerned about US debt repayment. Because if you look at credit markets, if I'm going to lend you money and you don't believe that I'm as likely to pay you back, you're going to charge a higher interest rate for that. And that's what's starting to happen, like you said, with the credit agency re-ratings on US debt. That just increases your kind of baseline interest rate. And so if rates continue to increase because the government has this unsustainable debt path, that makes it hard for so many businesses, for consumers. And it creates this dynamic where US debt on a corporate level is so very much based off of US government debt. And if all of those US government debt rates increase, then that's just going to create higher fiscal burdens for everyone across the board.
Yeah, exactly.
And so what I'd kind of like to talk through is, is there anything that the US can do at this point? I mean, what have people been talking about? Really, there aren't a ton of options, but I think it's worth kind of going through maybe some of the things that the government could potentially do to help solve this problem.
Yeah, so I think the biggest concern here is that the bulk of the US government spending is on entitlement programs. That's Social Security, Medicare, and Medicaid. And so at the top of that list for potential threat, potential reduction, is that Social Security benefit that so many people rely on and so many people are banking on. We're paying into it right now. We're paying into a system that we don't even know is going to be around by the time we retire. Certainly won't be around in the same sense that is today, in that either the retirement age is going to have to increase, or something is going to have to change with the government deficit, or probably with the government spending. But that's something that no political party wants to touch with a 10-foot pole, because like I mentioned, so many people rely on it. So many people have been paying into it for so many years with this expectation of a future return. Well, it's a losing proposition for any politician to suggest changes to it, but eventually push is going to come to shove and something will have to be done. Other options for the government, get a little bit, more fringe, as far as they can increase taxes to help offset this. The deficit is at such a level that it would be a drastic increase in taxes and a total change to what we're used to. a reduction in spending, like I mentioned, but we don't have a whole lot of discretionary budget to cut if we wanted to. Like I mentioned, that our discretionary non-defense spending is about the same as our just interest payments every year. So it's not like we have a whole bunch of fluff that we can just cut out of it. That's not, that's just available for the taking. And then finally, probably the most difficult way to, go about this is to increase tax revenues through economic growth. That's kind of a longer term ideal of, it's the argument that people make for keeping tax rates low is to, long term grow the economy and just have, more dollars flowing and interacting being taxed at a lower rate in order to, again, increase those tax receipts. So, it's a combination of things, but it leaves us without a really satisfactory answer.
Absolutely. I think that the economic growth piece is probably the nicest part as far as the long-term solution, but that's going to have to start with a balanced budget in the near term. You're going to have to let inflation kind of erode away the cost of that debt over a long period of time, the economic growth to continue to increase tax revenue. And that's going to be, in the long term, the best solution for this problem. So I know that neither parties really want to deal with this issue right now, but it's definitely something that people are paying more attention to. And as we noted, I mean, as far as financial markets go, something that everyone, including ourselves, is paying a lot of attention to.
Indeed. And it's like you mentioned, it's a long-term problem that needs a long-term solution. Any short-term solution is going to be a very painful one. One way or another, it's not going to be a satisfactory ending. So it's something we need to get started on now and work towards for the long term.
Agreed. Well, I don't think we gave our listeners any, comfortable feelings about the government debt just based off of this episode, but hopefully just something to continue carrying on the conversation, inform people about what's going on, what the implications are, so that this noise around the budget can continue to get louder, create some pressure on those, political representatives. Maybe they'll get something done sometime, before you and I turn gray.
Definitely. Thanks, Victor.
Thanks.